Charlie Munger has come out recently and said that US banks are full of bad commercial property loans. Warren Buffett has said that we are not through with bank failures, that more banks will fail in the future, that banks often take things to an extreme amount of risk and this results in them failing. Anyway, without further ado, let's go a little bit deeper into their argument. So Charlie Munger said US banks are full of bad commercial property loans. Berkshire Hathaway Vice Chair foresees pain in an FT interview, but says it will not be as severe as 2008. Charlie Munger has warned of a brewing storm in the US commercial property market, with American banks full of what he said were bad loans as property prices fall. The comments from the 99-year-old investor and sidekick to billionaire Warren Buffett come as turmoil ripples through the country's financial system, which is beckoning with a potential commercial property crash following a handful of bank failures. So essentially, if they have these bad commercial property loans on their books, are they going to want to renew these loans? Maybe not. This is one reason why we may see a potential commercial property crash. Munger said it's not nearly as bad as it was in 2008, but trouble happens to banking just like trouble happens everywhere else. In the good times, you get into bad habits. When bad times come, they lose too much. AKA, when good times come, the managers, the employees of banks, they give out these loans very, very easily so that they can get their bonuses. But a lot of these loans are bad loans. They're loans where people are going to struggle to repay them. Berkshire has a long history of supporting US banks through periods of financial instability. The sprawling industrials invested $5 billion in Goldman Sachs during the 07-08 financial crisis, and a similar sum in Bank of America in 2011. But the company has so far stayed on the sidelines of the current bout of turmoil, during which Silicon Valley Bank and Signature Bank collapsed. Berkshire has made some bank investments that worked out very well for us, said Munger. We've had some disappointments in banks too. It's not that damned easy to run a bank intelligently. There are a lot of temptations to do the wrong thing. A lot of temptations to give out a lot of loans, get those bonuses, but those loans may not be that secure. The reticence stems in part from lurking risks in banks' vast portfolios of commercial property loans. A lot of real estate isn't so good anymore, Munger said. We have a lot of troubled office buildings, a lot of troubled shopping centers, a lot of troubled other properties. There's a lot of agony out there. He noted that banks were already pulling back from lending to commercial developers. Every bank in the country is way tighter on real estate loans today than they were 6 months ago, he said. They all seem to be too much trouble. So the problem is, when you have bad commercial property loans, just think about, what does bad mean? Bad means that they're probably going to struggle to get people to rent out the commercial property, and it means that the actual property is probably overvalued. Now, if you think about it, if they're struggling with rent, they're going to struggle to meet their interest payments that they owe to the bank, and this may result in them defaulting on their loan. This in turn results in the bank getting the collateral that they have, which is the commercial property itself, which is overvalued. So the banks are left holding an overvalued asset, and they're left not getting their income, their regular interest payments. This is the problem with being a bank shareholder, and, well, it may potentially be a problem with being a bank depositor. Although Warren Buffett says if you're a depositor, you shouldn't really worry. Let's see what he said.
Are we through the banking crisis at this point?
Well, we're not through with bank failures, but we are through the depositor. The depositors haven't had a crisis. The owners of banks may have lost a hell of a lot of money. The people who bought the debt of the holding company, they may lose a lot of money. People can lose a lot of money, but the depositors aren't. And so you don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about. I mean, it is really, it's like we thinking that I just don't know why you do it with people. We set up the FDIC to relieve the worry of people. And initially, it wasn't the same institution it is now.
But you're saying on one hand, okay, no depositor is going to lose money. On the other hand, you're saying we're not through the bank failures.
Banks can go bust. But depositors aren't going to be hurt. I mean, banks can go bust. I mean, the Continental Illinois Bank was thought to be impregnable, back many years ago. And, the Franklin National Bank, the Bank of the Commonwealth. And sometimes they go broke because they make too many dumb loans, and sometimes it's because they mismatch maturities.
So more banks will fail, but it should be the shareholders, the owners of these banks, that should get hurt. Depositors, he said, will be fine because of the FDIC. Now, do you know what the FDIC is? The FDIC is the Federal Deposit Insurance Corporation. It's an independent agency created by Congress to maintain stability and public confidence in the nation's financial system. The FDIC insures deposits, examines and supervises financial institutions for safety, soundness, and consumer protection. Obviously, they didn't do a great job on this with SVB Bank and Signature Bank. It says they make large and complex financial institutions resolvable and manages receiverships. Now, the important thing to note when it says that it insures deposits, you need to know this. The FDIC protects the money depositors place in insured banks in the unlikely event of an insured bank failure. Unlikely, maybe not so much in this day and age. Each depositor is insured to at least $250,000 per insured bank. You need to note that down. At least $250,000. So if you have more than $250K, especially in those smaller regional banks, not the banks that are too big to fail, so to speak, but the smaller regional banks, then I would be more concerned. Then I would maybe look for other options. Warren Buffett thinks that you'll be fine. I don't know. I think you'll only be fine up to $250K. The rest I'd be a bit more worried about, personally.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago, or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact.
Banks were the ones who made these bad commercial property loans. They were the ones managing the business, giving out these loans that turned out to be bad. They should have included this into their calculations, these risks. They should be the ones that take the losses. The government, the taxpayer, because the government is the taxpayer, that's where the government gets their money. The government shouldn't have to step in and bail out these banks and just give them a bunch of money because they made all of these bad mistakes. No, it should be the banks that take the hit. If we look at their income, well, let's take a look at their income. Income, $28 billion. So maybe their income in the future should not be as high because the people who took out the loans will not be able to meet their interest payments, aka they will not get as much income in the future. Maybe these investment securities, $617 billion, $983 billion, or the latest figures is 1.1 trillion and 1 trillion, maybe these shouldn't be as high as they are reported to be. They should take the losses. Take out $100 billion of that. As Warren Buffett said, a lot of these banks, this is Bank of America, I believe, yes, Bank of America, they can afford to take these losses. It should not be the government, the taxpayer, who has to bail out these banks. They should just take the loss on their balance sheets and on their income statements for their income in the future. Now, the interesting thing about Warren Buffett is he's been selling out of a lot of his bank stocks. Bank of New York Mellon sold, US Bancorp sold. These aren't small sales, big sales, 91%, 60%. Originally, he reduced it by 35 to 14%, but then he just basically got rid of these stocks. Wells Fargo, he sold by 100%. If you look at his overall portfolio now, he's only got one bank stock as a major position, and that is Bank of America at 11%. The rest, he's essentially getting rid of. My guess is he's looking at these banks' balance sheets, he's looking at these banks' income statements and saying, well, will they be able to continue their profit that they've got in the past? Because a lot of these loans were bad and a lot of these interest payments are not going to be able to be met. And when you get the collateral, when they default on them, well, maybe these commercial properties are not worth as much as you say they are, so their assets should be devalued. So personally, from my perspective, they're not the type of stocks that I want to be in. I want to be in stocks where income is secure, where income is almost guaranteed, where income is growing. Same with the balance sheet. They're not my type of business. I'm not going to be buying into banking stocks, I'll tell you that. And even just looking at the Oracle of Omaha, he's selling out of a lot of his bank stocks, where previously he quite liked the banking sector. He owned a lot of banking stocks before. So yeah, I'm not going to be investing in banking stocks. And just looking at things from a depositor's perspective, I'd want my money in the bigger banks that are too big to fail, because there is safety in numbers in these type of situations. The government will not let these major banks fail because there'll be too much pain in the markets and too much pain for citizens. But if you're in those smaller regional banks, especially if you have more than 250K in those smaller regional banks, then I would look at adopting a different strategy, perhaps moving to the bigger banks, perhaps spreading my money between different banks below 250K in each bank, maybe looking to treasuries instead, looking to other asset classes. Guys, be safe out there.